So I like to tell the story about how right after college I was a hot dog vendor and outside the Houston Convention Center, and it's a great way of talking about costs. So if we look at some information that I collected over the years, you can see that this was some of the statistics that I found out about the demand for hot dogs. So what do we get when we multiply price times quantity? Well, we get something that we call total revenue. And some of you might be wondering, who are these three people that paid $10 for a hot dog? And it just shows you that not all demand curves are 100% steeped in reality, but we do show it. So from this information, how much do you think that I should charge for my hot dog? And how much should I sell? Given this information. So take a moment and think about it. And if you think long enough, you might say to yourself, well, I don't actually have enough information to make that decision. And the reason for that is that total revenue does not equal profit. Total revenue tells me how much I took in, from the patrons, but it doesn't tell me about something else that's incredibly important, and that is costs. So, in order to understand profit, you have to understand costs. So once I put this information down, now you can easily tell how much I should be selling my hot dogs for, right? And the answer is obviously $1.25 based on the profit right here. So if you take total revenue and subtract total costs, you get the profit. So profit is an interesting concept, and accountants and economists look at profit differently. Accountants only look at something called explicit costs. And so these are out-of-pocket costs that literally are paid for at the time with cash or credit, and it's paid for using the resources of others. So an example of this is rent, the wages you pay your workers, the materials that you purchase for your factory, electricity bills, etc. Those are explicit costs. So total revenue minus accounting costs, which are only explicit costs, would be accounting profit. So an accountant might look at your books and say, hey, you've got $100,000 worth of accounting profit. Isn't that fantastic? But an economist looks at both explicit costs and the implicit costs. And so they look at this picture a little bit differently. Implicit costs are the opportunity costs that firms pay for using their own resources. So a way to explain this is sort of foregone wages, foregone rent, and time. So for example, let's take that same situation where somebody was earning $100,000 in accounting profit. Let's say, for example, that they had opened up their own pizza restaurant and they had an accounting profit of $100,000 at the end of the year. Well, it sort of depends on what business you were coming from when you decided to open up that pizza shop. So let's say that you had moved to a small town from New York City and you were earning $200,000 a year in New York City. Well, you gave up $200,000 to come open up this pizza shop. And so, in fact, an economist would say your economic profit is actually negative, because if what you gave up, your opportunity cost was much higher than your actual accounting profit. So total revenue minus economic costs, which include explicit and implicit costs, is what is equal to economic profit. And from now on in this course, all costs are automatically economic costs. So it already includes all of the opportunity costs that one person could imagine. So the other thing that we need to understand before we get into the cost curves are the idea of short run versus long run. So in the short run, there's at least one fixed cost and at least one variable cost. And in the long run, all costs are variable costs. The reason that this is important is because in the short run, you cannot change at least one fixed cost. So for example, let's say that you are a t-shirt making factory and you've purchased a large piece of capital machinery that you would consider a fixed cost, meaning that machine cost $50,000 whether or not you print one t-shirt or a million t-shirts. That is a fixed cost. Now, in the short run, you have to do all of your screen printing on that machine. You can continue to hire workers, you can buy more blank t-shirts, you can buy more ink, you can buy all these variable costs, but at the end of the day, you have this one machine that you're working off of, and that creates some different concepts like diminishing marginal returns. However, in the long run, all costs are variable. So in the long run, you could buy more machines if you needed to increase production, okay? And so in the short run, it's really a rate decision of how much you're going to produce, and in the long run, it's really a capacity decision. How big is your factory going to be, and what's going to be your total capacity? Moving forward. So the numbers here are not that important. What's much more important is actually the conceptual understanding of fixed cost and variable costs and what they look like. Like I said on the last slide, fixed costs are those costs that remain constant whether a firm produces 0 units or an infinite number of units. And you notice here, this fixed cost was $1,000. Maybe that's the rent of the building. Maybe that's a piece of machinery. It doesn't really matter. Variable costs are those costs that change when a firm produces from 1 unit to an infinite number of units, meaning the more units you produce, the more expensive it's going to be, and you can see that here in the variable cost column. As you produce more units, the cost goes up. So total cost equals fixed cost plus variable cost, and you can see that right here. 1,000 plus 1,085 is 2,085. So what does this look like on a graph? Well, again, you don't have to graph these individually, but what you can see here is that the fixed cost is just a straight line at 1,000 because it's set, and it is also the difference between these two parallel lines, right? So any number on this line subtracted from the variable cost will equal 1,000 or equal the fixed cost. Now, from this set of information, we can figure out 4 more cost curves, and that is the average cost curves, which become incredibly important. And it's done by taking these numbers and dividing them by the quantity. You will see other videos in this presentation that will explain this further, but it's pretty simple. If fixed cost is 1,000, average fixed cost is 1,000 divided by whatever quantity you're producing. If variable cost is 1215, then average variable cost is 1215 divided by 11. And if total cost is 2215, then average total cost is going to be that divided by the quantity. So let's see what that looks like. I'm not going to make you figure that out. We have an assignment related to that. But let's see, more importantly, what these curves actually look like. So we can see that average variable cost is a line that is ever decreasing, getting closer to 0. Now that should make sense because if average variable cost is $2,000 when you produced 0 units, then the line is going to ever decrease if that same $2,000 is divided by 10 units, 15 units, and 18 units. Average variable cost looks a little bit like this. It sort of decreases in the beginning and then begins to increase. The lowest quantity on the point is at quantity 10. And average total cost looks something like this. Again, at this point, average total cost curve, the lowest point on average total cost is at quantity 13. Here's a few important points, and these will be consistent throughout the course. And it's by far the easiest way to remember them. And the average total cost looks like a smiley face. So whenever you're drawing an average total cost, just draw a smiley face. The average variable cost looks like a smirk. Okay? And we probably will not need to even have an average fixed cost curve anymore, because if we got rid of the AFC, could you figure out what it is without the curve? The answer is yes. If you subtract the ATC minus the AVC, you get the AFC, right? So the AFC is the difference between the ATC and the AVC. Okay? So from now on, we will not need to be drawing too many AFC curves. The reason is of course obvious. AFC equals ATC minus AVC. So now we have one last curve. It's the marginal cost curve. And that represents the change in variable cost, or the change in total cost, as you produce one extra unit. And as you can see from this situation, we again have a very easy way to remember this. The marginal cost will always look like a Nike swoosh or a check mark. Okay? The only other thing that you need to remember is that the marginal cost will always hit the average variable cost and the average total cost at their minimum points. The reason for this is that it is in fact the marginal cost curve that shapes the average total cost curve. Because as long as the marginal cost curve is below the average total cost, it is pulling it downward. And as long as the marginal cost curve is above the average total cost, it is pulling it upward. And the same is true for the average variable cost. So in fact, it is creating the shape of the other two curves. Okay? We'll discuss that a little bit more later. You've read about the law of diminishing marginal returns, and you should understand that that point on your graph is going to be right there. Okay? That is when the costs begin increasing as more and more of a variable input are added to a fixed input. The additional output begins to go down, and if you're looking at costs, the additional cost begins to go up. So that's a brief introduction to cost curves. Please read more about it in the soft chalk. And that's it.